Hi there, and welcome to OneTrack. I'm Rob McGregor, and I'm recording this on the 30th of September with performance numbers to the end of August and all the latest news right up until now. I'm actually recording this from Tassie, about to start for day one of a 1 week holiday down there. It's a bit chillier than Queensland, but looking beautiful. Looks like a nice day today. It's been interesting times on the market, so I'm going to talk a lot about what's happening in the world. As usual, this recording is for clients of McGregor Wealth Management, and particularly those that utilize the CARE investment methodology. Anyone else, please do not act on anything we talk about in this video without seeking advice. It's personal to your own circumstances. I'm going to talk today, as usual, about the economic news. Put it into context, there's a lot of stuff going on. I don't think I've ever felt the media so negative and the rest of the world so negative. And yeah, that negativity is not always a positive in the markets. And I'll talk more about that. And mortgage rates, property, all the usual stuff. Just some of the highlights. We're seeing share markets as we speak fall again. I'll take you through that. But the share markets have dropped again in the last week, retesting the lows of a week ago as the markets respond to fears that the central banks are going to push the economies into recession. So I'm going to talk a lot about recession today, what it is, why they do it, why would they put the economy into recession, and whether it'll actually happen or not. Forecasters. All forecasts have a terrible track record of forecasting anything. And I'm going to touch on why the recessions aren't always a bad time for investors. Have a look at some of the data on the right-hand side here. We can see the cash rate still on the rise, up to 2.35%. 90-day bank bills, 2.91. We're starting to see good returns on term deposits. Down the bottom there, Macquarie have a 12-month offering of 3.8%. So all of a sudden, a decent return again for the first time on fixed income. So that's going to be good. Mortgages on the rise though. So variable mortgage at Macquarie about 4%. It's still a good number. When I think about all the mortgage rates I've had over my lifetime, this is still amongst the best ever. It will be hurting those that bought and maybe overextended themselves when rates were lower. Obviously, there's a lot of flack going back to the Reserve Bank governor, and maybe some of that's warranted. Maybe some of it's not. I would hazard to say anyone who borrowed expecting rates weren't going to go up till 2024 still should have been able to budget for the increased rates in 2024. And yes, it's 18 months earlier. And that's partly because the economy has recovered quicker than we thought during COVID. US inflation, Australian inflation, we're kind of waiting for more data. It looks like inflation will fall. The biggest concern around inflation is whether it gets into the wage system. And so far, so good. Everyone's worried about a 70s type inflation crisis. I've talked about that before. In our last few recordings, I don't think that's going to happen. The Reserve Bank, the Federal Reserve, and all the central banking authorities are going to go hard until they see that inflation number come down. That may cause a bit of pain. And ultimately, that's why the share market's down at the moment. It's anticipating that pain, and I'll talk more about that. Property markets have cooled off a little. You'll see the bottom left-hand corner here, and these are pretty small numbers. So this is monthly changes, to property, and we'll see slight negative. I'll take you through a full update of the capital city changes towards the back of this presentation. And the chart just down here, the AMP pipeline indicator, that black line shows that they're the leading indicators around inflation. So leading indicators means that they usually predict what's going to happen to the main indicator. Inflation's a lagging indicator. By the time it comes out, it's telling us what happened, not what's going to happen, whereas a leading indicator tells us what's likely to happen. So it looks like inflation should come down. Once again, no one can predict with any certainty. Look, some of the highlights on what's happening around the world. Inflation pretty much everywhere, all around the world. When we look down this inflation column, not so bad in China, not so bad in Japan, but the rest of the world, it's high single digits, so it's not crazy. Some of the good, record unemployment, low rates. So yeah, record low unemployments. This is a good thing. It tells you the world's not doing that bad. What you will see if we get a recession, and even if we get a slowdown, is unemployment rates going up. And that's the first bit I want to talk about with recessions today. Recessions hurt those, particularly the newly unemployed. For most people who keep their jobs, recessions are a time where interest rates actually start to go back. They're often better off. They don't feel like it because they're watching the media. But for most people, recessions are not a big thing. It's absolutely a big thing if you're one of the newly unemployed. So watching that, we expect that to potentially go up a bit. Global GDP growth, look on the year on year, there's been some phenomenal growth in some places like India, and even bits of Europe over the last the Euro area, 4%. It's slowing down, and you can see here the US and China had a negative quarter. Now this is still the June quarter. We'll get the September quarter numbers somewhere in the next 2 to 3 weeks, and that may, and I'm going to say this a few times, a recession is technically 2 quarters of negative growth. So 2 quarters of negative growth. We've had one in the US. We haven't in Australia. Our last quarter wasn't too bad. It was 0.9%. That's about 3.6 annualized. So if we got another negative quarter of growth in the US, you're going to see headlines, US going into recession. Now that's not true. What the headline should say is US has been in a very mild recession for up to now. So it's the 30th September as I record this. The US has probably been in a recession for 6 months. Now, a very minor recession, let me explain what I mean. If someone earns $100,000, that's their gross national income. And the country itself, so the US and Australia, also has a gross national income or GDP. So if someone earned 100,000 and for 1 year or for 6 months, they only earned 99,000. So if it went down 1%, they would technically be in a recession. Now, they've still got a very high income, and some of the recessions we've had in the past have been very deep. Think the global depression, GFC was about 10% down. COVID was down quickly, and I'll show you that number, but then up. But generally, a lot of recessions are fairly shallow. They're a slowdown, they're a pullback for those that have their jobs and for good companies doing good things. They're not really a slowdown at all, but the media will talk that up. So I'm going to talk more about that because we may see that recession word come up, particularly for the US. And keep in mind, reinforce that again, they've been in a recession, not they're going into a recession. Now, the recession may last a bit longer. The reason they're doing it, by the way, is they want to get rid of inflation. They want to get inflation back under control because they're worried about a 70s cycle where inflation led to wage rises led to inflation, and it got stuck in the system for about 20 years. Now, back then, there was no Federal Reserve, there was no Reserve Bank. They didn't have a mandate to try and stop inflation. This time they do, and they're doing that by putting interest rates up. Interest rates are a pretty blunt instrument. It takes about 18 months before they actually affect the market. First interest rate rises started about a year ago. What we'll probably see is a pause in interest rate rises over Christmas. Hopefully the data will catch up, and potentially that might be the end of interest rate rises because we'll get one more rise probably in October. There's different speculation on what those rates are going to get to, but hopefully we're starting to see the peak of it. The portfolio returns, and keep in mind these are to the end of August, they'll be a bit weaker to the end of September, and then hopefully we'll see a rebound. So the last year, you're seeing, say, a balanced portfolio back about 5%, and it's probably a little bit more than that at the moment. Over 5 and 7 years, they're in the 6% range, a growth portfolio about 7%, and a high growth about 7.5%. To 8, interestingly, our active portfolio, where occasionally we take some profits, over that 7-year period is about 8.8. So it's about 1.5% above the high growth portfolio and nearly 2% above the growth portfolio. So it's provided some extra returns in those times where we've protected some of those profits, and we expect to be able to continue to do that in the future. So yeah, no real good news on returns, but keep in mind the portfolios have one purpose in the long run, and that's to be a contributor to the overall financial plan where we put in these target numbers. So let me touch on one of the behavioral biases, as I usually do, but this one today I'm going to talk about recency bias. And this is the tendency that we overweight current information. So we treat whatever's happening right now as much more important than it is, or much more important than it will turn out to be historically. Little crises like this one often turn out to be, whatever. I look at the big recession in my history, which was in the early 90s, Paul Keating's the recession we had to have. And I remember that as being pretty good times. But in Australia, unemployment crept up to 10%. But as I said before, if you had a job, it wasn't so bad. Interest rates were dropping. It became a good time for young people to buy property. And the markets eventually took off. And I'll show you some of those numbers. I've updated this chart since last month, but we're back. We're down about 15% from the recent highs, post-COVID highs. Once again, this is now on the fear of inflation and reinforcing our process, not our process, but our model of the world, where most of the time the share markets rise up this wall of worry. So there's always something to worry about. But occasionally there's a boom. The last boom we saw was in 2004 through to 2008, where markets went crazy. Now, we had a little mini boom in the US recently, particularly in tech stocks. That has unwound, and that's contributing to this downturn as well. But some US tech companies down 50 to 70%. So that little boom or FOMO has wound back a bit as part of this. But these things are common. We make no attempt to predict the 10 to 15% downturns because it's impossible. There is no one in history that has a track record of doing that successfully. Not one person. So that's not something we should ever try and do. We just have to be aware of them and have to be aware of our tendency to want to make bad decisions at those times. Obviously, it feels like something you should run away from, but absolutely not the case. I want to talk about recessions, and I want to show you something on this chart. So this is the index chart. You see in our office, so it shows the share market going back to 1950. But one thing, and if you can see this, the light blue shadings vertically are historical recessions in Australia. And recession, as I said, 2 quarters of negative growth. So you don't find out you're in a recession until about 7 months in. So 7 months in, the headline says Australia's going into recession. What it should say is we've been in a recession for 6 months. And the interesting thing is, if you look back historically, about that 8-month time is often where the market bottoms. We go back to the 90s, and you can see all these red arrows. Market bottomed, just as they would have been announcing a recession. Back to the 80s, market bottomed just as they would have been announcing a recession. Same in the 70s, same in the 50s. So pretty much every time they talk about, once the media starts to confirm a recession, it's generally been a brilliant time to be buying into the share market and holding. So as we near the time where they might say the US has been in a recession, we definitely want to be hanging on, because often the next step is a really good recovery. We saw that in the GFC, pretty much every recession. And that reinforces my second point here, that the economy and the share market are not the same thing. Of course, they're related. When we've got a healthy economy, we get a healthy share market. But the share market anticipates and looks ahead. So the share market's always looking over the hill. It's looking for new information, because every bit of known information is built into the price. So I'll say that again. Every bit of known information is built into the price. So when the news comes out, if it's just confirming news that we already suspected, it doesn't change the market much. What we're seeing at the moment is the worriers starting to worry about maybe inflation is going to be worse than it is, and maybe it will, maybe it won't. No one can predict that. I don't think it will be, but that's just my opinion. And as I said, forecasters, self-included, have no great track record. We don't aim to predict what the share market's going to do in the short term. We know what it's going to do in the long run, because it grows. And it grows for 2 main reasons. We as humans evolve, evolution and innovation. We get better, faster, stronger. If we look at global GDP, and this only goes back to 2012, it's continually on the rise. So GDP is just the amount of stuff the world produces. So this is a good environment for companies to make money, because the amount of money that gets spent around the world continually goes up. Occasionally it doesn't. The red bars down the bottom are recessions. We had a recession in COVID. We had a recession in the GFC, and this is global. So every country experienced it differently. Australia actually didn't experience a recession in 2009 because our mining economy was on fire. So we were going fine. But even as you look at that, look at the little bit that it goes backwards in a recession. And once again, think about that. Someone that earns 100,000, all of a sudden it's only back to 99,000. They're still spending money. They might even just dip into their savings. And during the period post-COVID, Australia, the US, and most leading countries around the world built up an incredible amount of savings. The savings rate went through the roof. So most people in Australia have this war chest of extra money they either paid off the mortgage or built up in reserves that they're now spending if their income's dropping a bit. So that's going to provide a cushion. So this is the backdrop on which companies operate. And this is why, we have faith that in the long run, the share market will survive and prosper. The share market is like the crazy version of this. It goes up in the long run, but in the short term, its swings are much wilder. Some wise words from Shane Oliver, one of Australia's longest serving economists in the investment world. And just these are things I've talked about, so you know this, but I just thought I'd repeat them. But the share market pullbacks are normal, as I showed in that other chart. And it's just the price we pay for the higher returns that we get in the long run. You can't time those market moves, so it's highly important to stick to a good strategy. Selling the shares after something's done just locks in a loss at a time where it's likely we're going to see gains, particularly over the coming years. I can never tell you what's going to happen in the next months because it's too hard, but over the next couple of years, it's highly likely we'll see higher levels as we bounce back from that slowdown. Whether it's a recession or not, we'll see, but it's certainly a slowdown. And share pullbacks actually give us opportunity to buy in. So for those that have money available, there's certainly a chance to buy in more cheaply. There's certainly a chance to bring forward investments for our dollar cost averages. And that's something I'm happy to talk about with anyone that has got solid income from their business or their jobs, and happy to bring forward. I think this is an incredibly good time to buy. It may not be the best time, who knows, but it's looking back historically, we'll say it's a good time to buy. For those retirees, this is why we have our reserves, so we don't have to sell good assets. And we haven't had clients having to sell. We haven't had clients panicking selling, which means they'll win in the long run. We still get dividends during all this stuff. And we've got to avoid getting distracted by short-term noise and missing out on our strategy. Let me run through. So at the moment, we've kind of got the market at fair, but it's a complex world. The Australian market's probably a little cheap. US market about fair. But I just want to focus on this bottom chart here. This chart goes back to when I started work in the early 80s in the share market. And it's what we've built. In that time, we've had literally 30 or 40 downturns of more than 10%. So they're normal, they're inevitable. You can't escape them. They're the price we pay for the long-term returns. Occasionally we have a boom. We actually haven't had a boom now since the early 2000s. So we're long overdue for a boom. It's not something we ever want to miss out on by being out of the market. The big downturns, the big ones, we see how quickly the market always comes back from those, which is why we're staying. Our most recent downturn of COVID, which was a downturn of 36%, recovered the quickest out of any of the downturns, but that was because it wasn't caused by a boom. It was caused by a shutdown of the world. I'm going to run through some of this pretty quickly, but I did want to emphasize again, the media had their moment of glory during COVID. They got everyone in the world to watch literally daily to all the updates. As COVID is becoming a thing we don't care about anymore, and I say that collectively. It's just flying to Tassie yesterday. We're now no longer masks on planes. You see one or two people on the plane with the mask, but most people not. We've forgotten about it. We don't care about it. There's still stuff happening. I don't want to diminish that, but it's ancient history. So the media's had to fight for our attention. So they're jumping on weather events, catastrophizing those. They're jumping on market events, catastrophizing those. And the only way they get your eyeballs is to be as negative as they can be, to predict horror. This is a 15% downturn. It's not even close to being in the top 10 of all time. Yeah, and whether it develops or not, we will see. I don't think it will stretch much more, but once again, I can't say that for sure. And I am always realistically optimistic, particularly in a world where that GDP is still so high that companies will make profits, and eventually those profits rise, and that leads to an increase in the market. Let me give you an update on the market. So, and when we look at Aussie shares still over the last 10 years have averaged 9%. We've gone backwards about 3.5% in the last year, and yeah, you'll see we've dropped again post those numbers to be back where the lows were in June, July. May go back a little bit more today. Just looking at Wall Street overnight, it's down another 2%, but inevitably it rebounds, and you can see that, you know, over the last 10 years, someone who invested $10,000, you know, it's grown to about, you know, 26, 27,000 if reinvested. So a great place to invest. US shares to the end of August down 8% for the year. And as I said, the tech sector in the US particularly has come backwards more than most, because that's where the little bit of FOMO had crept in. But long term, you know, just a spectacular place for us. And you'll see, yeah, this is a fascinating phenomenon. Even though the US share market's dropped, the Aussie dollar has also dropped. So in the last few months, the Aussie dollar has dropped from 69 cents to 65. So what this does is gives us a bit of an insurance policy. So in our investments in the US haven't dropped by as much as our Australian investments. So that means the overall portfolio isn't down by as much, because the Aussie dollar gives us a cushion. Now, it hurts if we're traveling overseas because we don't get as much bang for our buck. But while we're happily spending in Australia, it makes the portfolio strain that little bit less. That's always been the case, by the way. In every major downturn over the years, the Aussie dollar drops. So it means the value of our international shares doesn't drop by as much as the headline numbers, and something that most people don't talk about, particularly the media. US small caps, a great place in the long run, you know, 10,000 to 50,000 over the last 10 years, down also 6%. Yeah, pretty average for the year, but it's just one of those years. It's a bit like a winter. You endure it, and the seeds of spring are already started and will come back. Global leaders, this is companies like Apple, Microsoft, Amazon, which you can see in the portfolio there, but also the Nestle's, the Procter & Gamble's, JP Morgan's, the Exxon Mobil, so they're big oil companies, Johnson & Johnson, big health companies. Spectacular place to invest in the long run. Over the last 10 years, it's been a 15% average. In the last year, down 4%, once again cushioned by the fall in the Aussie dollar, so not back to the lows that we had in June, like the Aussie market. Emerging markets is really copped the brunt this last year, down 18%. Very cheap, and probably a spectacular place to invest. What we as an investment committee do as we go through these volatilities is we rebalance. So at the moment, we're buying a little bit more of the things that are down, taking profits on the things that are up. And these little things are the things that add to performance over the time. So we're not doing big reactive thing, just the discipline of rebalancing adds value over time. And lastly, gold. And gold's been a weird one, spectacularly good through COVID. Over 5 years, it's done all right, 8.2%. Over 10 years, only 4%. So probably not much better than cash, but it provides diversification. So during volatile times, it goes up. It's, if we're expecting long-term inflation, you would expect the gold price to be going through the roof. The fact that it not also tells me that the market doesn't think inflation is going through the roof. In the long run, we've just got this little skirmish, a little battle with inflation that we're going to have to play out. It's causing the slowdown. That will be tamed. It's just a matter of how big a damage that does cause, what type of slowdown or recession it causes. Onto the property market. We know the property market goes through cycles as well. They're slightly different. I note this headline recently in the Australian Financial Review from Christopher Joy, who's a fund manager. has been predicting Armageddon in the property market with the word crash. And crash I would associate with 50% downturns. Christopher Joy has been predicting a 30% downturn. I would say the funds that he manages at the moment are not doing as well as others because his predictions haven't been correct. And I suspect he wants disaster. So his fund theories will play out. But let's have a look at what's actually happening. So I'd call this a bit more of a correction than a crash. In the last 12 months, you see the bottom left-hand corner, we've actually done spectacularly. For our investments in Brisbane, we're up 20%, Adelaide up 25%, Perth up 9%, Sydney and Melbourne down about 2%, hardly a crash. In the last quarter, so you'll see, we're down about 2%. Sorry, up top left is the quarter. Sydney down about 5%, Melbourne down about 3%, Brisbane down about 2%. Very much a cooling off, as I would call it, or a correction rather than a crash, and quite healthy as well. But there's some underlying conditions that are just so positive for the property market. The headwind, of course, is interest rates, but the tailwinds, population growth returning, massive shortage of accommodation. So rents are going through the roof. Talking to one of my property managers during the week, and one of my properties in Melbourne, tenants are leaving and we're able to put the rent up 25%. Part of me feels bad, but this is why we invest. And we keep it a fraction below market just to get people in quickly. But up 25% in that suburb since our last tenant review of just a year ago. So rents are going up. Ultimately, that makes a good investment. It helps investors pay a bit of the mortgage. So investors are getting a good return. They're unlikely to be sellers. There's the one worry in the property market is new buyers that bought, expecting rates to be lower for a bit longer. But Australia's got a tremendous track record of not defaulting on mortgages. We suck it up. We people will, if it's a two-couple family, one of them will go back to work, or one of them work a bit of overtime. We work out how to make it happen. So fixing rates, I still think you'd avoid that at the moment unless you absolutely wanted a guaranteed cash flow. Fixed rates, which are on the right here, 5-year fixed rates up over 6%. Same with the 4. Variable rates are more like 4.5 on average. As I showed earlier, you can still get rates of around 4. And if you're fixing at 6, you really need to see rates go through to 8% before you're better off. So I think variable rates are better. If in doubt, yell out. We can point you to some good people we work with on refinancing. There's a lot of us are going to come off low fixed year rates in the next 18 months. I know the media is trying to talk that up as this big cliff, but we'll settle into 4% type rates. It's not that bad. We'll suck it up. We'll spend a bit less on other things, or we'll dip into the savings, and hopefully people are ahead on that. Our friends at Herentide White show the property clock. There's a few more markets on the decline, including Brisbane now and Ipswich. The changes in the orange here, they're calling the Sunshine Coast at the peak. I think we peaked a while ago, by the way. So, and other places peaking. Not much. There's still markets rising. It's fascinating. Hobart, where I am at the moment, approaching peak. And in the unit market, much the same. So the main changes there. We've got Sunshine Coast and sort of the regional areas, Albury, plus city of Brisbane, all potentially peaking. And that is a pretty good summary, I think, of where we're at property-wise. So as I wrap up, look out the window in spring, enjoy the good things going on in life at the moment. Turn off the TV, avoid the media, particularly on the news. And just the summary, as always, our core philosophy that all investing is best done as part of a real plan. And that's where you've got your goals set up that are based on you and the important things in your world. Portfolio is designed to meet these goals with a long-term view and all the boring stuff, diversification, asset allocation, and enough liquidity to ride through these downturns. And low-cost index, the portfolios continue to do what they should do, which is not nice at the moment, but when the market's down, they're down. They will come back. Remember, there's only 3 ways to lose money. One is to panic and sell, and it's particularly important for people not to do that at the moment, and we haven't had that issue with our clients at all. Have to sell, which is where you need the money. That's why we have the reserves and not properly diversified, and you guys all have massive diversification. So thank you for your attention, and look forward to seeing you soon. And yeah, have a great day. Rob McGregor signing out.